And
Sorry.
that's
Go
okay.
ahead.
Part of my job is to answer questions that people might have about the law, and or resolving issues informally that they might be having with their plan or employer. And the other part of my job is to do these presentations on employee benefit topics that are really important, but no one really goes to school learning these things, right? It's just kind of assumed that we know how to navigate these things. So that's the purpose of, these presentations. Today, I'm focusing on retirement savings, which is an important topic for all of us, no matter what age we are, because it's something that continuously we need to be working towards. So let's get right into it. And like I said, if you have any questions in the end, I'm not a financial expert, right? But this is just general information to get started, but I would happy to, try to answer your question, or refer you to someone who might be able to better answer it. So this presentation is called Savings Fitness, and it was put together by the Department of Labor as well as the Certified Financial Planner Board of Standards. There's actually a great publication that goes along with it. And so at the end of the presentation, I'll give you a phone number and you can actually request a hard copy of the publication, and then I'll also provide a link so you have an electronic copy of it. But the publication is really great because all the topics that we cover today, it will go more in depth, and then we'll also actually help you start calculating and like really processing these ideas and how it relates to you, and to actually crunch some numbers. So that I'll make sure to give you that information at the end. My goal for this presentation is for you to feel empowered, right? Sometimes with these financial talks, you feel really overwhelmed, you feel like you're late to the game, but with this presentation, I really want you to feel empowered, explain how to save your money to make it work for you, and how to protect it so when it will be there when you need it for retirement. And then just remember, there's no such thing as starting to save too early or too late. It's just not saving at all. Okay, so we're gonna go with that thought. So, savings fitness, let's do a financial warm up. So let's think about it. Your retirement is actually the most expensive purchase you will ever buy. People are now living longer and are more active in their retirement because science and technology, people lifespans are just longer right now. And you may have to pay more for retirement than people have had to pay before. So now more employers, instead of offering traditional pensions, they're offering a 401k, right? And so that's actually your money going in, and we'll talk about more of that later. Social Security provides a minimal foundation and protection for your retirement, but it would be difficult, especially in the Bay Area, to live just on Social Security. A comfortable retirement is really your Social Security and employer-based retirement benefits that you have. So that's a pension or a 401k, any personal savings, and private investments. And let's be realistic here. Many of us live paycheck to paycheck. We might have more pressing financial needs and goals. And perhaps you've waited until close to your retirement before starting to save. But you can take steps now to have a more secure future. And you might want to think of, what age do you want to retire? Normal retirement age is age 65, right? But depending on the type of work you might be doing right now, that might not be conducive, right? If it's labor intensive, you might not be able to do work for that long. So it's important to be realistic about that. And then retirement isn't going to save itself, right? I mean, you're not going to win lotto and then that's just going to fix all your problems. We have to actively build our wealth. So just some things, to be intentional about this process. So getting fit and managing your financial life, we want to talk about our goals. Let's start right there. And to make a goal more concrete, you want to actually write it down and organize between short term, which is your 5 years, less than 5 years, and long term, which is more than 5 years. And you want to prioritize your goals. So, what's most important to you, and what do you need to work towards right now for your finances? And because we're here today for the savings fitness and we're focusing on retirement, you really want to make retirement. We're trying to urge you to make retirement a priority. So think about that, and not just write down a goal like, say, I want to buy a car, right? Or I want to buy a house. You really have to process, how am I going to get there, and how you're going to accomplish each goal. So here's a little worksheet here, and this is from the workbook that I was talking about, that I will make sure that you get a copy of at the end, to help you start processing and breaking down your financial goals. So let's start with a short-term goal here, right? So the short-term goal is 5 years or less, and this person said that their goal is to start an emergency savings fund. And they were specific by when they wanted to complete it. They want to complete it in 1 year. And how much will it cost? So they figured it will be 6 months of expenses. That's how much they want to save. And this person has acknowledged that they've already started working towards this goal, right? So they say that they've saved 3 months of expenses. And then they said specifically what they're going to do to reach this goal. So this person is going to fill out these worksheets, find out more about savings. So, that's you here, because you're in this webinar right now with us. And then this person's going to bring lunch to work instead of, bring lunch to work every day instead of maybe eating out. They figured, looking at their budget, that might be a good way to save their money, that they can save their money. So that's a short-term goal. Now, long-term goal is, longer than 5 years. So this, that, for depending on your age, that might be retirement. And so by when does this person want to complete it? By retirement age. How much will it cost? Well, this person has figured out a percentage of their pre-tax pay. And what money have they already saved for this goal? So this person has an IRA. So, acknowledge what you've already saved. And what are you willing to do? So this person says that they're going to sign up for a workplace plan. So maybe at their job, they offer a 401k plan. So, and this person wasn't participating. So this person has decided that they're going to participate in their 401k plan. Okay, so after you have your goals, what do you do? Well, it's important to assess where you are. And one way to do that is to figure out your net worth. Now, that might sound, harder than what it really is. It's actually pretty simple. Whatever your assets are, so whatever you own minus your liabilities, what you owe, that's your net worth. So your assets are what's actually in your bank account now. If you have any retirement accounts, the amount of in your retirement accounts. If you own a home, if you own a car, everything that you own, that's your assets. And then your liabilities is what you owe. So if you have any loans out there, including student loan, car payment, anything like that, that would be your liabilities. You subtract that and you get your net worth. So that's just one way to look at things. It doesn't include everything, all your financial resources. You might be paying into disability insurance or healthcare insurance, life insurance, and that's also going to give you some financial payback. But it's a good way to, they say maybe to assess yearly kind of where you stand. So once you figure out your net worth, we can start kind of really thinking about figures here. Estimate how much you need to save for your retirement. So let's be honest. I mean, if you're making 50,000 a year before taxes, you're probably going to need about that to enjoy the same standard of living when you're retired. They say you should figure about 80% of your pre-retirement income. Of course, everyone is different, but that's just an estimate. Think about how long you will live in retirement. So today, a 65-year-old man expects to live approximately 21 years in retirement, and a 65-year-old woman can expect to live about 24 years in retirement. But these are just averages, right? So they recommend planning to live well into your 90s will help you secure retirement and outliving your income. So, to think about that, what you need to live well into your 90s. Think about what sources of income you'll have during your retirement. So social security, which is, depending on how much you worked and how long and what your wages were. If you have any employer sponsored plans, 401k pension, savings, investments, think about that. And then how many years left you have until retirement. And the reality is, the more years you have, the less you'll have to save each month to reach your goal. So, I mean, just thinking about numbers here, most financial experts recommend that you save 15% of your gross income um, to get to your secure retirement. Now that might be a lot, right? 15%. You might not be able to do that right now. So you might want to start with 8 or 7%, and then maybe in 2 years maybe go up to 10 or 9, right? But the idea is that you want to get up to 15% as soon as you can. So just thinking, the workbook I mentioned actually has formulas, so you can get a number to figure out what you'll actually need. I don't want to go. I mean, we could have gone through it today because we have a small group, but I'll invite you to do that on your own, to figure out what number it is for you. So then, once you have a number and you know what you're working towards, you have to think, so how am I going to save? So I mean, first is managing your cash flow. um, this is kind of, not really exciting stuff, right? But creating a budget and a spending plan to keep track of your expenses each month. So, what I would recommend is, just for 1 month, keep track of all your expenses, you know, whether that's rent or your mortgage, maybe your car payment, average food bills, and just keep track of how you're spending your money. And then after that, you can look and see, where your money is going and kind of figure out where you can cut places. So for me, during the pandemic, I had just moved out to California. I'm from New York. I didn't know a lot of people. Luckily, I moved out here because for a job, but I wasn't spending a lot of money because I just didn't really have a social life, and it was COVID. But when things started opening up, I was kind of had cabin fever, right? After being in lockdown. So I was ready to go out, meet people, go to restaurants and stuff like that. And then I looked at my bank account. I'm like, what is happening here? Like, where is my money going? And so for me, what I did was I really had to kind of limit the amount of times I did like takeout and going out to restaurants, right? And I set a budget for myself, like, okay, I'm only going to do that um twice, like take out twice a month, because I can cook at home, and then maybe going out to eat like twice a month, right? Just to do something that was realistic, and then eventually like cut back more. But everyone's different, right? And you want to be realistic with yourself, because sometimes you set yourself on a budget and it's not realistic, and then you just go off on it. So you really need to personalize it and make sure that it's good for yourself. And there's tons of apps out there that can help you, free apps that can help you with budgeting, so you might want to look at that. So let's be realistic again, thinking about where we currently stand financially, and our financial setbacks. Good to assess your debt situation. So there's good debt and there's bad debt. Good debt is debt that's going to give you financial payoff. So, paying for your education, maybe a car to get you to work. These are all things that you might have to take out a loan, but in the end, it will help you with your financial gain. Now, bad debt, not to be like too simplistic, but that is, borrowing to go on vacation, or to travel, or to buy new clothes, or get new furniture, right? I mean, these things that we really shouldn't be borrowing for, extras. So, warning signs: if you're having a debt problem, borrowing to pay off other loans or regular bills, creditors calling for payment, maxing out credit cards, being turned down for credit. Um, with credit cards can serve many useful purposes, but oftentimes we misuse them. I'm pretty old school, and so I am like, I'm learning about credit cards and all the points and stuff like that. And I can see how having a credit card and obviously having a good credit score is really important. But, it's really important to be able to pay it off each month. I mean, I'm looking at this right here, making only a 2% minimum payment each month. So doing just the minimum on a $2,000 balance with a credit card charging 18% interest, it would take 30 years to pay off the whole amount. And so that's just, wasting your money, right? 30 years for $2,000. So, just to be mindful about that. And, if you are having issues with debt, there are services out there, credit counseling services that can help you set up a plan to work with your creditors and reduce your debts. Or you can work with creditors directly to try and work out payment arrangements. Okay, so now let's think of, now we're getting into it. Tips on how to save smart for retirement. So I said it before, and I'll probably say it a few more times during this presentation, but one is to start now and don't wait. Time is critical. And then to start, when I say start now, starting small is okay. If necessary, money may be tight, but even small amounts can make a big difference. And one tip that you can use is automatic deductions. So you're not even thinking about it and you're already winning. If money from your paycheck is just going straight into a retirement account, you're not even thinking about it. It's not even hitting your bank account. It's just going straight there. And so that's huge, the automatic deductions. I think that is a really helpful tool for people to save, and that helps you to save regularly. You might be in a a kick and be like, okay, I'm going to save these next 3 months and then I'm going to go on vacation and have fun because it's summer, right? No, like we got to think of how to be consistent. And if that's starting small, that's okay, as long as it's, a regular contribution you're able to put towards your retirement. Be realistic about investment returns. I'm not a financial guru, but sometimes people make poor decisions because they think that they're going to get something big in the end from an investment. So it's important to be realistic about that. And then roll over retirement account money. This is huge. You know, we live in a very expensive area. And with my job, a lot of people call because they want to cash out their 401k. So say that they were working with another employer, they had a 401k with them, they got another opportunity, they started a new job. Instead of rolling it over, they're like, no, I want the money now and I want to cash it out. And I really, if you can, discourage that, because again, like we talked about the automatic deductions, once that money hits your account, you're going to spend it, right? I mean, that's just what's going to happen. um and then when you cash out your 401k, it's not you're losing money because there's a penalty, an early withdrawal penalty. And so there's a percentage that you'll lose. If you roll over, so say that you work for another employer and they offer a 401k plan, usually you can roll over your old 401k into that plan. And so, and continue with that, or you could roll it over into a retirement account, an IRA. So that's another big tip for retirement savings. And then don't dip into your savings. So it's tempting to see, like, you got this pot of money right here, like I looked at my retirement account, my 401k that I have for my job, and I'm like, wow, I didn't realize that I had, like, that amount. And so I have plans, and it's really easy to go in there and take a loan, right? But you want to try to not do that, because that's your nest egg. That's what you are going to use when you get to that age of retirement. So that's one thing. And then, want to quickly talk about compound interest. This is huge. Basically, it's making your money work for you. So with compound interest, the money you put into a savings account earns interest, right? And then you earn interest on the money you deposit plus interest already accumulated. So your interest is earning interest, and that's not even your money. I mean, it's your money originally, but then there's interest and then there's more interest. So it's basically, it's not you working another shift, it's just you putting your money into the savings account. So let me like break it down for you. Say a 20-year-old saves $100 per paycheck, right? For 10 years. If this person did that, they would make 50,000. So from that, when they're 30 years old, if they have that in a retirement account with 7% interest, that will double each decade, right? So from 50,000, it will go to 100,000 at 40. So that means just from that $50,000 that the 20-year-old put in every paycheck, $100 per paycheck, by the time she gets to 70 years old, she'll have $800,000 just based on compound interest. So that's again, not you working an extra shift, another job. That's just your money growing on its own because of interest. So, even if you don't have a 401k, you can look at your bank to see if there's some type of savings or interest account that can help you get there. But that's something that's, really important to take advantage of with compound interest. So we're gonna talk about employer-based retirement plans. That's why I'm here with the Department of Labor. important, when you're looking at new jobs, to evaluate their benefit programs, not just look at salary, but also to see if they offer any retirement benefits, right? So basically, there's two types of retirement benefits. There's your traditional pension plan, which we call a defined benefit plan. And there's the defined contribution plan, which is most commonly like a 401k. So your traditional pension plan, they're less popular now, right? Um, it used to be that you worked for an employer for 10 years and then you would get a pension from them, right? But now not a lot of employers are offering pensions. Pensions, they were a guaranteed benefit, so you'd have to work for the employer for a certain amount of years to be vested. Maybe 5 years, say. And then if you work there and if you were vested, then you were guaranteed a benefit at age 65, right? And the payout is based on a set formula. So it's usually based on how long you worked there, what your wages were. They have a formula, and based on that, it will have a amount for a monthly annuity. So a check that you'll get every month for the rest of your life. Um, and the pensions are your employer's is funding the plan. So it's not your money going in. So the employer says, okay, if you work with us for a certain amount of years, when you get to retirement age, you can apply and you will get this usually monthly paycheck. Sometimes you can get a lump sum, but most pensions are like a monthly check. And then two, if you are married and have a spouse, say you pass away, your spouse would be able to get a survivor benefit. So yeah, pension, I mean, if you have a job and find out that they offer a pension, I mean, that's I'm not saying for you to take the job because of it, but it's something that you really want to consider. Um, Most employers, though, they offer a 401k plan. If it's a nonprofit, maybe a 403b. I work for the federal government, so I have a thrift savings plan, but it's all pretty much the same thing. You say it's a no guaranteed benefit because you don't have to participate, right? It's your choice because it's your money from your paycheck going into the 401k account, and the amount is based on how long you participate, how much invested, how much you put in, and the investment performance. So it's usually attached to investments. And the 401k is your money, so your money going in from your paycheck, but some of them offer a match or employer contributions, so the employer is also paying. And that's huge because not all plans have to offer a match. But if your plan does, that's great. And I would encourage you to um, make your contributions based on what the match is. So say that your employer is going to match 5% of your salary. And the employer is saying, okay, if you put in 5%, I'll put in 5%. That's free money, right? I mean, that's like you if I mean, it is your money going in, but you're getting 5%. Like that's an extra bonus. So I always tell people, I know money is tight, but in the end, that's gonna pay off for you. So even, if you look at looking at a new employer and their benefits package, if they're offering a match, that's something that's really good that you want to take advantage of. More things about how to make the most of your defined contribution plan, because that's what most of us have. Join your plan as soon as possible. Like I said, there's usually not automatic enrollment. Some jobs, benefits are mandatory as part of employment, but most of them aren't. And so you actually have to request to be a participant of the plan. So, join as soon as possible. Some plans have, eligibility requirements, like you have to work there a year to start um, to contribute and be a participant of the plan. But, make sure that you know or are aware of that so you can make an informed decision for yourself. Obviously they're going to say put in the maximum amount. That's based on IRS regs. I think it's 20,500. I think it just increased based on the IRS regs, but a lot of us can't do that, right? So at least try to contribute enough to maximize the employer contribution. So that's the match that I was talking about, because at least you'll be getting that. And then if you can do more later, that's what I said, like figure the 15%. If you can't do 15%, you maybe start at 8. But, try to do more later. Study the menu of investment choices. Learn as much as you can about plan fees and your plan in general. So if you have a 401k plan or any type of employer sponsored plan, the plan will have a summary plan description, an SPD, and that is a summary of the legal plan document. So in there, it will have information about investments, eligibility, vesting requirements, like that. That basically the law says that the plan has to follow the rules of the plan document. So it's really important to get your hands on that. And if you're a participant of the plan, anyone can request that, right? And then again, keep the money in the plan. So we talked about this. Try not to borrow from your retirement or permanently withdraw funds, cash out your 401k. That will reduce your nest egg. You're going to have to pay federal and state income taxes. And on top of that, a 10% penalty for early withdrawals. So, you're losing a lot of what you've already saved. So if you're able to roll it over, that's what we would recommend. And some other things to consider with your employer-based retirement plans. So there are tax breaks when you contribute to a defined contribution plan. There may be some tax breaks. The money you invest in the plan and the earnings on those contributions are deferred from income tax until you withdraw the money, hopefully not until retirement. So you're not those contributions aren't taxed. They will be taxed later. So when you think about it, the tax deduction means that the decline in your take-home pay won't be as large as you might think. So let's say you are thinking about putting $100 into your retirement plan each month, and the rate you pay on income taxes is 15%. Your $100 retirement plan contribution would actually only be reduced your take-home pay by $85, and that's because of the income tax and the tax break. So that's something to think about. You will be taxed later, but it might be of interest to start making your contributions now. It's important to be aware of the vesting rules of your plan, right? We talked about that with pension plans, but 401k plans also have vesting requirements. So for your contributions, the money that you put into the plan, you are always 100% vested. So those are always yours, right? But if the employer has a match, that there are vesting requirements for that. So the plan might say that you have to work there for 3 years to get the match. So that's important to think about if you're changing jobs, right? I mean, that's the reality of our modern workforce. We usually don't stay at the same job for 20 years. I mean, some of us might, but it's just important to think about, because sometimes what happens is, you might work for an employer for 2 years and they're like, you know what, this isn't working out for me. I want to look into something else. It might be in your best interest, if the vesting requirement is 3 years, to stay for the extra year, because at least you'll get that match from that employer, so it's just kind of thinking about what is the return in the end, and to be mindful of that, because sometimes people call when they get you know, maybe they're rolling over their 401k, and they'll say, hey, you know, there's $5,000 missing. What happened there? And it was like, oh, you know, just because how long you worked there, the vesting, that money went right out. So just to be mindful, because that does happen, and people call about that a lot. And then, like I was kind of talking about before, like being informed of your rights. Um, you know, that's why we're here with the Department of Labor. Most employers want to do the right thing, and I would say most employers do a good job with managing their retirement benefits. But sometimes things happen, right? Financial troubles, you know, stuff happens. I'll just leave it there. And so it's really important, if you are participating in a 401k plan, that you are monitoring your funds. So don't just take for granted that things are happening the way they should. So if money from you, if your employer, if you're working at a company and they're doing payroll maybe like twice a month, right? That's your money from your paycheck should be going into your 401k twice a month. It shouldn't, you know, you want to make sure that there's nothing missing, and you want to make sure that there's not an issue with lateness, because sometimes that makes then that means that things will be missing later, right? Because there's an issue with making those payments. So just to be mindful of that, before I started this job, I wasn't really monitoring that. I just took for granted that things were happening the way that they should be. But with this job, I've really learned it's important to be monitoring that, because sometimes, you know, stuff does happen. And if there is an issue, you see that, you want to give us a call and we can help you with that. You know, wouldn't disclose your identity, would just, you know, do a review of the plan and try to help resolve the issue. So I hope that this was a workout worth doing. As you know, once you start kind of getting working on these goals, and you know, get your budget together, you know, start you know, looking at your 401k or your retirement or savings account, you know, you keep wanting to monitor your progress. So you want to review your spending plan, monitor investments and adjust as needed, right? You know, things will never be always static, stay the same. Contribute more towards your retirement savings as income increases. So say that you get a promotion, right? um, you know, instead of just keeping that money and letting it hit your bank account, you know, just start putting more into your retirement account. Because, you know, once you get used to getting paid a certain amount, it's hard to, you know, to go back. But if you know that you were living comfortably off a certain salary, then you know you can contribute more towards your retirement. Let me see here, and just keep your finances in order and organized, right? So be mindful, you know, what you get in the mail, right? Don't just like leave it in the junk mail and get to it maybe 2 months later. You know, make sure that you're looking at the statements or the documents that you receive from the plan. If you move, make sure that you keep your address current with the plan. We get a lot of calls from people who sometimes, you know, I had a 401k with this employer. I moved. I don't know what happened. The employer, they changed names. I can't get in contact with them. You know, they're owned by someone else now. So it's really hard to backtrack. So it would be much easier if you just either, you know, maybe rolled over the 401k, but if you want to leave it with the plan, make sure that your contact information is accurate, because, you know, that's even worse if you've already earned a benefit and then to lose out on it because you didn't keep your contact information up to date. You know, that's really unfortunate. So yeah, that's it for my presentation. If you have any questions about if you have an employer-sponsored plan, feel free to give us a call. Our phone number is 866-444-3272. And I promise, I know sometimes calling the government, you have to wait a long time to reach someone live. Or maybe sometimes you don't even able to talk to someone live because there's so many people on the queue. One thing I'll say about our department, you won't have to wait a long time to speak to someone. You'll speak to someone like me, or, a real person. And then, we can on the phone kind of sort out, okay, what your personal situation is, not really give financial advice, but if you have questions about the law or have any issues with getting any documents, or there's just an issue that's coming up with your retirement plans or health benefits, definitely give us a call because we want to help you, and it's all free. And then, I don't work for the Certified Financial Planner Board, but that's their contact information there if you're interested. And what I'll do is I will put the link for um, the the publication, let me see here, in the chat, so you can look at that. And then if you'd like a hard copy of that publication, the workbook that I was talking about, feel free to give us a call and we can help you with that, get you a copy free of charge. And so that's the link for the pub, and that's based on the presentation. But like I said, I'd be happy to mail you a hard copy too if you'd like that. So that's it. Do you have any questions, and if you would rather call the number, that's fine too. And I know that was just a lot of information that I threw at you.
Okay, I do have just a few questions.
Mhm.
So one of them is, okay, so you said the 15%, that's how much you should be saving. So that's per month, 15% per month of your income?
They
And
say
not
gross, right? So that's
all 15% of your gross a
yeah,
year. So
yearly,
it
yeah.
yearly, okay. Got
Yeah. And that, I mean, if you, like I said, if that's not possible for you right now, that's okay. But the idea is to get to 15% as soon as you can.
Okay, okay. And then you also mentioned about the free apps that help you budget. Do you have like some of the names or?
Um, I think there's one, let me see here. I'll look really quick. I think it's called Mint. Let me
Mhm.
see here. Oh, I deleted it. Let me just do Mint app. I think that's what it's called. Yeah, so I know it's called Mint. I'm pretty sure that this one is free, but if you just Google free apps to help with budgeting,
Mhm.
that will help you with that. And then the publication that I mentioned, that will also kind of give you, it's not an app, it's
Mhm.
old school like paper, but that will also kind of gives you a framework to work with the budgeting too.
Okay, yeah, because see, that's why I don't know how to budget at all. It's
In
just go get what you want. I had to stop that, and it's hard for me. So,
Yeah, no, I think it's hard for everyone,
mm,
we live in a
yeah,
consumer society, all the billboards and all of that,
right.
it's a reality. But I think, if the earlier you are able to figure out where you can cut from that
Mm-hmm.
and being realistic, the better off you'll be. But, we're all working. I mean, I'm working on it too, I'm gonna be
Okay.
honest. But there are a lot of tools out there.
Mhm.
And I know I've used Mint and I think it's free, but I know that our pub also has a good framework for that.
Okay.
But I really think like for budgeting, sometimes we're too hard on ourselves,
Mhm.
right?
Right.
And I think it's better to first just look to see how you're spending your money, right? So
Mhm.
like just look at a month and look maybe at your credit card or debit card and see like, where the money's going,
Right.
how you're spending
Right.
your money. Kind of I'm old school. I
Mhm.
like wrote it down, right?
Mhm.
And then I was like, wow, I'm like spending a lot on takeout. There's no,
Yeah. Oh, that.
like, come on, I
Oh,
have
I
food in
love
my
DoorDash
fridge.
all the time.
Yes,
That's what I say. I'm gonna cut that DoorDash down. I mean, every day. DoorDash.
yeah,
I'm like, this don't make no sense. You work from home, so you could cook you something even when you
exactly.
between a call, you know.
Yeah. No, so that's what I say. But be realistic. I mean, you enjoy DoorDash, that
Right.
convenience, right? So, you don't want to totally cut that out, right?
Right. No.
Maybe reward yourself to like once or twice a month,
Mhm.
or maybe if you're ordering every day, maybe just do it once a week or
Yeah.
once every 2 weeks.
Or
But
even like the groceries and stuff. I need to get my lazy tail up and go to the grocery store
I
myself
know, I
instead of
know.
like okay, but it's so convenient,
It,
I don't have to bring the groceries in, they leave them at the door. Like I don't have to carry these groceries up the stairs myself. So but
yeah.
I'll guess like for my water and stuff, I could just have them instead of everything I need on the list.
Right, right. Yeah,
Yeah,
just be realistic with you stuff. And you just have to start where you're at.
yeah,
And if
yeah.
it's like maybe just cooking one meal a week and maybe you can
Mm-hmm.
make that, get maybe 3 meals out of that. I don't know. If
Yeah.
you like leftovers, but
Yeah.
just figuring that out. But I think, what might work for me might
Mhm. No,
probably not going to work for you
right.
or Vicky, you know what I mean? We're
Mhm.
all different. So I think with budgeting, sometimes people are saying, do this, do that, do this.
Right.
If you like to get your coffee out, don't do that. But it's
Yeah.
like, I mean, if you like your coffee out, that's
Yeah,
okay.
right.
But you might have to
To
cut
cut
that out,
somewhere else.
something else
Yeah.
out.
Hmm.
So but yeah, I would say mint, and then you can look at our pub for that. I'm sorry I don't have more suggestions.
That's okay. So, like, what are like good investments? Do you know?
Yeah, I can't. That's
You,
something that I
oh,
can't
that's
do,
something.
right?
Okay.
Yeah, I mean,
So,
even like I don't really have my knowledge is limited, and then
mhm,
two, just as the government, I can't
you can't do
like
that.
sponsor that, anything. But
So, is that what because what is the what is it, certified financial
Financial.
planner? Now,
planner,
what do they do?
I'm not sure all the services that they provide. I think that, if you're a financial planner, you have to go through some type of certification process. And I think that
Mhm.
they're in charge of that. And I know I've been to their website before and they have resources for the public.
Oh,
So they
okay.
might have also more information about budgeting
Hmm.
too, because that's kind of more we're Department of Labor, so we're really
Yeah,
looking at
you
the
more on the left.
employers,
Yeah, the law.
401ks, right? Exactly.
Okay.
But
Yeah.
the financial planner, I mean, they're
Mhm.
really looking at your money, right?
Mhm.
So that probably, I know I've been to their website and I know that they have resources with budgeting and that, but I don't know like all the services that they offer.
Oh, okay. Okay
Yeah.
then.
Sometimes most of them will charge you money.
Mhm.
If I do a financial planning for you,
Oh, so
I will
they.
charge certain amount of money. Yeah, they are not.
Oh,
Most
okay.
of
Right.
them are not free. Yeah,
Right.
most of
But this
them.
website, I think
Uh-huh.
they have free
Some
resources.
resources.
Okay.
Yeah.
Yeah.
Okay.
Mhm.
Yeah.
Mhm.
But you also want to be wary of like, financial planners because
Yeah.
sometimes they'll want to sell you a product.
Mhm.
So I would think that the financial planner board would have information on like what to look for and what to ask for on that. But I know, that's something to consider when working with
Mhm.
someone that, you know, that they're not just working for their agenda. They're looking
Right.
out for you and a good fiduciary.
Yeah.
Okay. That's good. I learned a lot.
You did? Oh, good.
I
I'm
did.
glad.
He was handing the flower. I'm like, oh, that's something I want to learn. So,
Yeah.
oh, and see, and two, because I work and I have a 401k, and my employee does pay out 50%.
Wow.
Mhm.
Yeah, I mean, what they match, it's
They
match.
match it,
Yeah,
right?
they match it. So, yeah, so now that I know what I should be kind of look, how much I should put in, so you
Yeah,
said
I
the match.
mean, right. Yeah, you want to look at the IRS regs for because you can max out, right?
Mhm.
But if you're not able to make the maximum contribution, whatever
Mhm.
that is,
Yeah.
you want to at least get the match.
Yeah, I don't know what the max is, so I need to figure it out and try to work towards that.
Yeah. But
Mhm.
but definitely like the match, if your employer offers that, that's awesome. That's great.
Yeah.
And that's
Mhm.
free money. That's
Right.
not money coming from your paycheck. So
Right. Oh,
yeah.
and what about, because you were saying the saving account, the compound. Now, what is that? I mean,
Yeah, it's kind of the workbook I mentioned really goes over it, like the
oh,
mathematics
okay.
behind it. But
Mhm.
basically, I mean, if you have a savings account that
Mhm.
there's if you're putting money in, like I said, the 20-year-old was putting $100 a paycheck in. So
Yes.
just that, she did it for 10 years, it would be like $50,000. So
Mhm.
then you have interest, right?
Mhm.
There's interest that's building. But the idea with compound interest is that your money will be, you keep your money in this account for so long that money interest is growing on interest.
Yeah.
So it
So,
just keeps multiplying and getting
mhm.
bigger and bigger. But it only works if the earlier you start, the better
Yeah.
off you'll be, the more that it
Mhm.
will grow, and then you can't touch it.
Oh,
You have to leave it there
leave
to
it
let it
there.
grow. So I
Mhm.
mean, if you have a savings account, if part of like a credit union or something like that, they can help
Mhm.
you with that. If you have a 401k, it's usually like 7%.
Mhm.
But yeah, I mean, I don't want to go into all the
Yeah.
math of it because we're like going towards the end of the program. But yeah, I mean, look at it though, because I wasn't really aware of compound interest until I
Yeah.
started this job, and I was like,
Mhm.
whoa, like I
Mhm.
can't believe I could have, started earlier, right? And been
Yeah.
in a better situation. But don't look back, just start now, right?
Yeah. Okay.
But then if you know any have any know any young people in your life, like I
Mhm.
always encourage young people to start thinking about savings because they'll be better off in the end,
Yeah. Right.
so yeah, I know we're
Oh,
close to time, right, Vicky?
oh,
Yeah,
we
we are
about
coming to the
7 o'clock.
end. But
Oh,
thank you. Those are wonderful questions you have.
Mm-hmm.
thank you.
Yes, thank you. Yeah.
Mhm.
So
Okay.
we in the future we can do more similar programs. I think there are a lot of people want
Mhm.
to know the same thing as you want to know.
Yes.
Yes. So
Yeah,
we can plan that in the future for the future.
Definitely.
Yeah. Yeah.
yeah.
Yeah. So
Okay.
unfortunately, it's getting to the end of the
Right. I know.
program.
Look, I'm off work, so I know you guys ready to get off.
Okay.
I just,
If you have any advice, any question, you can always reach out to me. I know you come to library,
yes.
and we will try to do more similar programs, or we can ask Mona back to give us more talk. And that's, we hope you can, you feel free to talk to us. Yeah.
Okay.
But thank you. This is wonderful.
Yes, okay, and thank you, Mona. Thank you.
And thank you for
you.
coming. Thank you for
Okay.
coming, give such a wonderful presentation, right?
Thank
Okay, you
you.
guys
Thank
enjoy
you.
the
Thank
rest
you.
of the day.
Yeah,
Okay,
thank you,
bye-bye.
everybody.
All
Thank
right,
you. Have a
bye.
nice evening.
Oh,
Okay,
Vicky.
thank you.
Okay, great.
It's kind of fun. Yeah. I know how to do this program now. I kind of understand it now. I think maybe the way I target, I will talk to some librarians at the, east side of the neighborhood, and the one that librarian is very interesting, and see if she will be interested in the future. Maybe we can do it together, or maybe she can, go
Do it at the
ahead.
branch. Yeah.
Yeah, when everybody can come to the branch, and it would be nice, because a lot
Yeah.
of people, they need this kind of information.
Yeah, I agree. Yeah, and I think this is a good. I like this
I like it too.
presentation because, like, I think anyone could get something out of it.
Exactly.
It's simplistic, but then there's some things like with the employer benefits, the 401k. People don't know.
Or they know there, but they don't, just ignore it. Or
Yeah, like they get mail and they just put it aside and not really monitoring what's going on, don't know about that there's a match, like just missing out.
right. And this is good. And I will coordinate with some of the librarians. If they already have a patron come regular for their programs, I think we should target that way. Probably
Yeah, that's
it's better.
true.
Yes.
Yeah, because is she someone that you see regularly at the library?
Yes, she
Yeah.
come to the library. That's why I hand her the flyer. I said, you have to come. And she said, oh, this is exactly what I need.
Yeah, no, and she asked really good questions
Yes,
too.
yes, wonderful. And thank you for wonderful presentation.
Oh yeah, no problem. I'm happy. I enjoy doing these presentations. So
Yeah, you did a good job. And
thank
because
you.
you are so easy, make it so easy to understand. And
Oh,
people is not scared if you get
right.
a financial,
Yeah, it's
financial plan is with
intimidating.
all the numbers.
I know. That's why I don't like to go. I put a few numbers in, but I don't like to fixate on the
Yeah.
numbers because it's too much. I give them the information later that they can figure out the numbers if they want.
Yeah.
But yeah, I just want people to feel empowered.
Exactly. Good job. Good
Thank
job.
you. Okay, Vicky. So we'll be in touch.
We'll be in touch. Thank you very much.
No problem.
I have a good
Bye-bye.
evening.
Have a good
Bye-bye.
night. Bye-bye.